You check your net worth on a Tuesday afternoon. The number glows on your screen, $1.4 million. You did it. You crossed the threshold. You're in the top 10%. You made it. Except when you look at your bank account, when you try to buy a house, when you calculate what retirement actually costs now, something feels off. The number says you're wealthy. Your life says otherwise. You're running faster than ever and somehow falling behind people who had less 5 years ago. Welcome to the largest wealth percentile compression since 2008, where the goalpost didn't just move, it grew wings and flew to another zip code entirely. My name is Alex, and for the past 8 years, I've been reverse engineering wealth data that makes absolutely no sense until you see the full picture. And if you're trying to build real financial security in 2026, make sure to hit that subscribe button, because what I'm about to show you explains why your 6-figure salary feels like it buys a 5-figure lifestyle. Here's what nobody's telling you. The net worth that made you wealthy in 2020 is now barely enough to stay in the same percentile in 2026. According to the Federal Reserve's Survey of Consumer Finances released in October 2023, the threshold to crack the top 10% jumped from $1.2 million in 2020 to $1.92 million in 2023. That's a 60% increase in just 3 years. And projections based on asset price trends and inflation data suggest it'll hit 2.1 million by the end of 2026. But here's the thing that makes this truly insidious. Even if your net worth grew by that 60%, even if you rode the stock market up 129% since 2020, you're not actually wealthier. You just maintained your position while the cost of everything that matters surged past your gains. This is the financial optical illusion of the decade. Your portfolio says you're winning. Your purchasing power says you're treading water. And the gap between those two realities is where the American middle class is quietly drowning. Let me paint you the full picture, because this isn't just about numbers on a screen. The Bureau of Labor Statistics data shows cumulative inflation of approximately 25% from 2020 to 2026. That means every dollar you had in 2020 buys you 75 cents worth of goods today. CNBC's December 2024 analysis confirmed it. Prices are up about 25% since January 2020. Your $150,000 salary today has the purchasing power of roughly $120,000 in 2020 dollars. You got a promotion, a raise, maybe even a bonus. Congratulations, you're still behind. But inflation alone doesn't tell the story. It's what inflated that destroys you. According to the National Association of Home Builders and CNN Business Analysis, housing prices increased 55% nationally from 2020 to the third quarter of 2025. 55% in 5 years. Zillow's housing price index shows major metros hitting 40 to 60% increases, with markets like Austin, Nashville, and Boise seeing gains over 80%. The U.S. Bank Asset Management Group found home prices surged 40% from June 2020 to June 2022 alone. That's 2 years. The Harvard Joint Center for Housing Studies and Federal Reserve Economic Data confirm the same trend. Housing, the single largest component of wealth and cost of living for most Americans, became radically more expensive faster than almost anything else in modern economic history. Now here's where it gets truly absurd. While housing prices jumped 55% and your dollars lost 25% of their value, the S&P 500 delivered a total return of 128.71% from 2020 to 2026, according to S&P Dow Jones Indices. If you were invested, if you had assets, your net worth probably grew substantially. On paper, you're crushing it. In reality, you're discovering that a 7-figure net worth doesn't buy what it used to when the house you want cost $800,000 instead of $500,000, when property taxes tripled because assessments follow market prices, when insurance doubled, when the retirement you were planning requires 40% more capital than it did 5 years ago just to generate the same lifestyle. This is percentile compression. The wealth threshold to stay in the top 10% rose 60% in 3 years. Not because Americans suddenly became 60% richer, but because asset prices inflated so dramatically that the barrier to entry skyrocketed. If you weren't already holding significant assets in 2020, if you were saving cash to buy in, if you were early in your career building toward that first home purchase or that investment portfolio, you got obliterated. The ladder didn't just get taller. Someone lit the bottom rungs on fire while you were climbing. And here's what makes this different from normal economic cycles. Usually, when asset prices rise, it's because the economy is genuinely growing, productivity is increasing, real wealth is being created. This time, we printed more money in 2 years than in the previous 2 centuries, handed it directly to asset holders through unprecedented monetary policy, and watched real estate and stocks moonshot while wages and productivity barely moved. The Federal Reserve's own data shows this. The people who owned assets in 2020 saw their net worth explode. The people who didn't, who were saving in cash, who were waiting for the right moment, who were playing by the old rules of fiscal responsibility, watched their purchasing power evaporate and the finish line sprint away from them. Let me show you exactly how this plays out in real life, because the statistics are one thing. The human cost is another. Imagine you're a high-income professional in 2020. You're making $130,000 a year. You've been saving aggressively. You've got $200,000 in cash for a down payment on a house. The median home price in your market is $500,000. You're planning to buy in the next year or two. Responsible. Prudent. Exactly what the financial advisors told you to do. Now it's 2026. You got raises. You're making $150,000. Your savings grew to $280,000. Your savings grew to $280,000. You did everything right. Except that $500,000 house is now $850,000. Your 25% down payment went from $125,000 to $212,000. And even though you saved more, even though you earned more, you're further from homeownership than you were 5 years ago. Meanwhile, your coworker who bought in 2019 with a smaller down payment and a lower salary now has $400,000 in home equity without lifting a finger. She didn't work harder, she didn't save better, she just owned an asset when the money printer went burr. That's not a financial system, that's a lottery, and the ticket sales closed in 2020. What I'm about to show you next is the thing that took me years to figure out, the mechanism that separates the people adapting from the people getting crushed. Stay with me here, because this is where it gets useful. The traditional advice says accumulate net worth, get to $1 million, $2 million, $5 million. Hit the percentile thresholds and you're set. That advice is now obsolete, and here's why. Net worth is a snapshot denominated in a currency that's losing value while being measured against assets that are inflating. It's a moving target painted on a rocket. You can't win by chasing the number anymore because the number itself is rigged. According to Census Bureau data and the Federal Reserve's Survey of Consumer Finances, wealth distribution compressed at the top while expanding at the middle. The gap between the 75th percentile and 90th percentile shrank, not because the middle caught up, but because the cost of entry into the top tiers exploded. You need more wealth than ever just to maintain the same relative position, and that wealth has to generate more income than ever just to maintain the same lifestyle. This is the trap. You're optimizing for a metric that no longer correlates with the outcome you want. So here's the shift. Stop accumulating net worth for the sake of the number. Start building cash flow that's resistant to monetary debasement. Let me break down exactly what that means, because this is the difference between struggling at 1.5 million and thriving at 800,000. First, understand the difference between nominal gains and real purchasing power. Your stock portfolio went up 129% since 2020. Incredible. But inflation was 25%. Your real return after inflation is closer to 83% over 5 years. That's still good, roughly 12.8% annualized in real terms. But now subtract the lifestyle inflation, the higher housing costs, the increased property taxes, the insurance hikes. Your actual increase in standard of living might be 30 to 40%. Maybe. You're not getting rich. You're running in place on a treadmill that's speeding up. Compare that to someone who built cash flow, rental properties generating income that rises with inflation, businesses producing earnings that scale with price increases, dividend stocks that increase payouts over time. These assets don't just appreciate nominally, they produce income streams that adjust as the currency debases. The net worth might look smaller on paper, but the actual lifestyle, the actual financial security, is often substantially higher. Second, accept that geographic arbitrage is no longer optional, it's survival. The wealth compression is not uniform. According to Zillow and Harvard Joint Center data, housing in Austin increased over 80%, while some Midwest markets stayed flat or grew 10 to 15%. A $300,000 income in San Francisco might afford you a median one-bedroom condo and a retirement plan that requires $5 million. That same income in Nashville or Boise bought you a mansion and early retirement in 2020. Now, even those markets are expensive, but the principle holds. Your percentile ranking is increasingly tied to your zip code. High earners and high-cost cities are experiencing this most acutely. The traditional tech salary of $250,000 to $400,000 that once meant automatic wealth now means you're house poor, paying 60% of post-tax income toward housing, unable to save enough to offset the wealth threshold increases. You're nominally in the top 5% of earners and functionally in the middle class. Meanwhile, someone making $120,000 in a low-cost area with a paid-off house lives better and retires earlier. The solution isn't necessarily to move, though for many that's optimal. The solution is to build optionality, remote work capabilities, income streams not tied to physical presence, asset allocation that isn't concentrated in your local real estate market. You need the ability to arbitrage cost of living without sacrificing income. That's the game now. Third, shift from market volatility hedges to monetary debasement hedges. Most people prepare for the stock market to crash. They hold bonds. They keep cash. They diversify across sectors. All good. But none of that protects you from what's actually happening. Currency devaluation masked as economic growth. When the money supply explodes and asset prices surge, your cash hedge loses value. Your bonds get destroyed by inflation, and your diversification within dollar-denominated assets just means you're losing purchasing power in multiple ways simultaneously. The Federal Reserve's balance sheet went from $4 trillion in 2020 to nearly $9 trillion at its peak. That money didn't vanish. It went into asset prices. It's why housing is up 55%. It's why stocks are up 129%. It's why the wealth threshold jumped 60% in 3 years. And it's why holding cash or fixed income instruments during this period was financial suicide. You need assets that benefit from, or at least survive, monetary expansion. Real estate, even at elevated prices, because you're borrowing devaluing dollars at fixed rates. Equities, because companies raise prices and their earnings grow nominally even if real growth is modest. Commodities, precious metals, anything scarce that can't be printed. I'm not saying go all in on gold or Bitcoin. I'm saying your asset allocation needs to account for the reality that the dollar is worth less every year, and the trend is not reversing. We're in the home stretch now, and this is where most people check out because it gets uncomfortable. But if you've made it this far, you need to hear this. The psychology of wealth is changing, and if you don't change with it, you lose. For decades, the American wealth script was simple. Go to college, get a job, save money, buy a house, invest in your 401k, and you'll be comfortable. That script assumed certain constants. It assumed housing prices would grow roughly with inflation. It assumed wage growth would keep pace with cost of living. It assumed a dollar saved today would buy approximately a dollar's worth of stuff tomorrow. Every single one of those assumptions broke between 2020 and 2026. You're watching people younger than you, less educated than you, less responsible than you, become wealthier because they happen to buy a house or start investing at the right moment. That creates a psychological crisis. You did everything right according to the old rules, and you're losing to people who, by those same rules, did everything wrong. It feels unfair because it is unfair. The game changed mid-play and nobody announced it. Here's the hard truth that might sting a little. The system is not designed to reward hard work or fiscal responsibility anymore. It's designed to reward asset ownership. The person who saved cash got punished. The person who went into debt to buy assets got rewarded. That's not a moral judgment. It's an observation of mechanism. And once you understand the mechanism, you can stop being angry about fairness and start positioning yourself correctly. The Federal Reserve's actions since 2020 effectively transferred wealth from savers to borrowers, from cash holders to asset holders, from people waiting to enter the market to people already in it. They did this knowingly. It was the explicit goal of monetary policy: inflate asset prices to create a wealth effect and stimulate spending. It worked. It also created the largest intergenerational and intragenerational wealth transfer in modern history. If you're still operating under the old psychological framework, if you're still trying to save your way to wealth, if you're still waiting for prices to come down or for the market to make sense, you will fall further behind every year. The new framework is this: borrow cheap dollars at fixed rates to buy scarce assets that produce cash flow and increase in nominal value as the currency debases. That's it. That's the whole game now. I know this isn't what you want to hear. You want to hear that if you just save a little more, spend a little less, work a little harder, you'll get there. And you can. but the there you're aiming for is moving, and it's moving faster than your savings rate. You have to change strategies. Now let me tie all of this together, because when you see how these pieces connect, the entire landscape shifts into focus. The wealth threshold jumped 60% in 3 years because assets inflated for monetary expansion while the currency devalued by 25%. Housing prices surged 55%, creating a barrier to entry that's historically unprecedented. Stock markets gained 129%, enriching people who were already invested while leaving new entrants priced out of reasonable valuations. And all of this happened while wages grew modestly, maybe 20 to 30% for high performers, meaning your purchasing power relative to the assets you need to build wealth actually declined even as your nominal income rose. This creates a multi-layered trap. If you're trying to enter the housing market, you need 60% more capital than you did in 2020 for the same relative home. If you're trying to maintain your wealth percentile, you need to grow your net worth 60% faster than inflation just to stay in place. If you're trying to retire, you need 40 to 50% more capital than traditional planning models suggested because everything from healthcare to property taxes to basic living costs inflated beyond core CPI. The people who are winning right now, the people successfully navigating this, have made 3 key shifts. They stopped chasing net worth accumulation and started building cash flow generation. They build geographic and career optionality so they're not trapped in high-cost markets with stagnant opportunities. And they hedged against monetary debasement by holding assets that benefit from or survive currency degradation rather than assets that get destroyed by it. You're not imagining it. $1.2 million in 2020 really did buy more financial security than $1.5 million does today. A $150,000 salary really does feel like it buys less than a $120,000 salary did 5 years ago. The math isn't broken. The measuring stick is. And here's what that means going forward. The wealth percentile thresholds will continue rising as long as monetary policy favors asset price inflation. The Fed's dual mandate is price stability and maximum employment. They've decided that asset price inflation doesn't count as price instability, so they'll keep doing this until something breaks. That means the trends that started in 2020 are not temporary anomalies, they're the new baseline. If you want to build real wealth in this environment, you have to play the game that actually exists, not the game you wish existed. You have to accept that saving cash is losing purchasing power. You have to accept that waiting for prices to normalize means waiting forever. You have to accept that the responsible, conservative, slow, and steady approach that worked for your parents' generation is a guaranteed losing strategy in a world where the money supply can double in 2 years and the Fed considers that a success. That doesn't mean be reckless. It doesn't mean over-leverage yourself chasing assets you can't afford. It means be strategic about where you hold value, how you generate income, and what you're optimizing for. It means understanding that net worth denominated in inflating dollars is a vanity metric. What matters is how much cash flow you control, how much optionality you've built, and how protected you are from the next round of monetary expansion. Because here's the final piece that most people miss: this is going to happen again. The next crisis, the next recession, the next black swan event, the Federal Reserve will respond the same way they did in 2020. They'll print money, they'll buy assets, they'll inflate prices, and everyone holding cash, everyone on the sidelines, everyone trying to play it safe, will get crushed again while asset holders get bailed out. You can be angry about it, you can argue it's unfair, you can demand systemic change, all valid. But while you're doing that, position yourself correctly. Because the system doesn't care about your principles and it doesn't reward your patience. The goalpost moved. It's going to keep moving. The question is whether you're going to keep chasing it using the same failed strategy or whether you're going to change how you play entirely. So here's where you are right now. You're standing at a fork in the road. One path is familiar. Keep saving. Keep investing in your 401k. Keep trying to hit those net worth milestones. Hope that the next 5 years are different from the last 5. Hope that prices stabilize. Hope that your wages catch up. Hope that the system starts rewarding the behavior it used to reward. The other path is uncomfortable. It requires accepting that the rules changed. It requires borrowing when you've been taught to save. It requires taking calculated risks when you've been taught to be conservative. It requires building businesses and buying assets and generating cash flow instead of accumulating dollars in accounts that lose value every year. The first path is safe in the short term and devastating in the long term. The second path is scary in the short term and liberating in the long term. 10 years from now, you'll look back at this moment and you'll either regret that you didn't adapt when you had the chance, or you'll be grateful that you saw the game for what it was and changed your strategy before it was too late. Your future millionaire self, the one who actually has financial freedom and not just a big number in an account, is counting on you to see this clearly. The net worth threshold that made you wealthy in 2020 isn't enough in 2026. It's not going to be enough in 2030 either. Stop chasing the threshold. Start building the system that makes the threshold irrelevant. What financial trend are you seeing in your life that nobody's explaining properly? Drop it in the comments. That's what this channel is for. We're figuring this out together, one uncomfortable truth at a time. You're no longer stuck watching the goalpost move. You're building your own field where the rules actually make sense and the game is winnable. That's the difference between surviving percentile compression and thriving despite it.